What is going on, fellow income investors? Welcome to my channel. I am the covered call guy, and on this YouTube journey, my goal here is to create $120,000 in annual passive income just using covered call ETFs as of now, subject to change, of course, in the future when I hit my goal. My projected annual dividend / options income is about $82,000 a year, 6.8K a month, 1.5K a week, $226 a day, and about $9.42 per hour. I will be updating this at the end of every month. Probably February 26th or 27th, I will release an update. So let's hope my projected annual dividend / options income hasn't dropped by too much. All right. Legal disclaimer before we start though, this content is for informational and educational purpose only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube and I could be completely wrong. Now, today's video is going to be talking about one of the trifectas that I always hype and talk about. It is Amplified, right? Goldman, Amplify, and Niels is my trifecta. And for those who are getting into the income space, well, take a good look at Amplified because they have great income ETFs. Of course, pick and choose your poison there, right? There's growth and income, there's pure income, there's speculative crypto, and this one right now is a new one that they have just filed. So did Amplify just drop a good yield nuke, right? Is a 12% income strategy revealed. The filing date was February 17th, 2026. They dropped two. So let's talk about it. All right. So the news dropped and what just happened, right? So on February 17th, 2026, Amplify ETF have formally announced the following of two groundbreaking fixed income ETFs to expand their YieldSmart suite. Okay. So what is it? Well, the first one is Fund 1, which is LQDM. It is their investment grade 12% target income. And Fund 2 is HYGM. It is their high yield 10% target income. Right. So their strategy here is they're combining long bond positions with a cover call overlay. So my verdict here is yes, they are beating the old playbook style. They think it's broken too, which I've mentioned multiple times. So what I'm seeing here is it's a shift from the boomers and Gen X into a more millennial and Gen Z kind of future environment, right? Amplified, I think it's engineering a solution for the cash trapped for us younger generation, right? Trying to get you paid without forcing you to gamble on more risky stocks. All right, let's look at the macro vibe check and why now, right? So I think one is the Fed pivot. So after hiking to a 5.25% interest rate, the Fed began easing in 2025, and by early 2026, they pretty much executed three rate cuts, bringing the benchmark to roughly around 3.5 to 3.75, right, give or take around there. Sometimes a bit higher, sometimes a bit lower, just depending on the situation here, right? So the inflow tsunami, right? So investors have been flooding into bonds, U.S. fixed ETFs, right? U.S. fixed income ETFs attract over 400 or close to 400 billion in 2025 alone. I made I talked about this in the video, right? It's pretty much you see the money just flowing in. So Amplify seeing this, right, sees that cash yield are dying, and if you're sitting in a market money fund, you're essentially losing income every day unless it's just your cash buffer. Then that's fine, right? But if you're dependent for income, right, everyone else is chasing a higher yield right now, right? So let's look at the yield paradox, right? The math ain't mathing, right? And here's the problem I do see with natural yields, right? As of talking about February 2026, they aren't enough. If you want to look at the investment grade of LQD, right, this is the natural yield of 4.91%, right, versus a high yield of HYG. Their natural yield is about 6%, but look at Amplified, right? It's double, right? Amplified target yield of LQDM is 12%. Amplify's goal here is trying to manufacture synthetic yield, right? So they're trying to bridge a massive gap between the 4.9 and 12 using volatility, right? What is their secret sauce, right? This is their yield smart tech, right? So it's a secret. They don't tell anybody. It's probably how they're trying to manufacture this yield, right? Most cover call funds are dumb in a way that is 100% passive and just uses a strict metric, a rule based, right? They sell calls at on 100% of the portfolio every month, right? Amplify uses a variable coverage ratio, pretty much on, pretty standard for their fund here. What that is, it's just looking at high volatility. When the fear is high, premiums are richer. That's just the way it is for every option play here. But how their fund, what they do is they only overwrite 40 to 50% of the portfolio. The result is you keep more of the upside. But what happens during low volatility? Well, when markets are calm, premiums are cheaper, right? The fund overwrites 90 to 100%. The result is, yes, your upside in this kind of environment is a little bit more capped, right? It is not magic. It is an algorithm. But the warning here, the prospectus says these funds are non-diversified, meaning concentrated risk. So keep this in mind. We'll talk about this later in the video. All right, let's look at the weekly options. This is the speed run here of drawing from TLTP. Pretty much the precedent from that is that these funds will likely use, I think, weekly options exploration. First is to capture the data, right? Option lose value fastest in the final 5 days, right? Amplify have to harvest this decay, and it gives them the agility. That reset strikes 52 times a year, right, versus 12 times, which is the monthly. And the benefit of this is that it reduces the risk of being locked out of a rally for the whole month. So this is, I think, their psychology and their thinking behind this. All right, so this strategy right here, like I'm summing it up, speed kills the premium. By selling weekly, they are trying to milk the option market for every cent of the time decay here. All right, so let's do a quick deep dive on LQDM, the 12% beast that they're releasing. So this is their underlying is some iShares LQD, right? This is their investment grade corporate bonds, okay? It's doing bonds here. The target is 12% annualized income. So looking at the 12% minus the 4.9% natural yield equals a 7.1% gap they have to fill. So to generate that over 7% in pure option premiums from pretty much a boring, stale bonds, LQDM has to be aggressive, right? It likely needs high coverage ratios or strikes close to the money. The trade-off, if you're buying LQDM, it is pure income vehicle, right? You're essentially swapping any chance of capital appreciation for immediate cash flow. And I know some of you guys in the comments like your fixed income. All right. Let's look at LQDM versus the old guard of LQDW. Looking at these two, you can tell the strategy is different, the coverage is different, and the frequency is different. The row here, Amplify is more aggressive versus iShares is more defensive, right? So you're looking at, you can consider this the upgrade, right? LQDM is structurally superior for active traders because of variable coverage. I think their strategy here is better suited for cover calls or income investors, so because it isn't stuck at 100% of the capped upside if volatility does spike. All right, let's do a quick deep dive on HYGM. This is the 10% sweet spot that they're trying to put out. Their underlying is, again, iShares from HYG. This is the high yield. This is the junk bonds, right? Their target is a 10% annualized income. So looking at the 10% target minus a 6% natural yield, they do have about a 4% gap to fill. So this is, in my opinion, a little bit more remarkably conservative, requiring only about 4% from options allow HYGM to write calls on a much smaller portion of the portfolio, right? So anywhere from 30 to 40%, maybe even 50%. All right, they're feeling risky here. So I think the logic here for this one is HYGM is growth tilted. Okay, I put that in quote, growth tilted, because the option burden is lower here. That's what I'm seeing. That's what I'm guessing. All right, so it does retain a little bit more of the upside participation, but it is junk bonds with a safety belt. So beware, that safety belt might be a little rusted, and you could fly off at any time if you're going too fast, right? All right, let's look at HYGM versus the old guard of HYGW. Looking here, their target yield it's about the same, give or take. It is 1 or 2% lower. The upside potential, I want to say, is much better than iShares, right? It's a higher potential with a lower burden. The risk profile, though, it does have higher beta. In this remark, because you are kind of playing with a more upside potential with your options overlay, right? So HYGM does win in a soft landing environment. That means that if the economy recovers and spreads tighten, HYGM captures the growth while HYGW misses it. All right, but let's look at the risk check, right? We always got to worry about the NAV trap, right? This is the return of capital part, right? Distribution may include return of capital. That means if the fund fails to generate option premiums because of low volatility, it pays you back your own principal to hit the 12% target. The good, of course, it is tax efficient, defers taxes. The bad, right? I would rather just pay the taxes because the bad erodes net asset value, which is your NAV over time. In the morning, of course, don't ever just look at the yield. Watch the NAV. If the NAV is dropping while the yield is 12%, you're basically eating your own tail. You're gonna eat yourself alive. All right, let's do a risk check. This is the FOMO pain, and what do I mean by that? Capped upside and rate rallies. So while the variable coverage does help, the risk still remains, right? If interest rates fall sharply, bonds rally, and your calls get exercised, right? So this is the research here this is the research data. I like to put actual data and then my scenarios. So let's look at the data here. Treasury cover calls has a 2.9% return. Holding bonds outright 3% return, right? So over a long period, cover call lags slightly, right? So insurance does cost money. You are paying for stability, but if the bonds go to the moon, you pretty much stay on that launch pod and you don't run with the bull, right? You're pretty much stuck. You're not going to go with the bull market. All right, so who is Amplified? All right, Amplified is led by the CEO, Christian Magoon. Search him up, like him. I follow him on social media. I have his announcement on notifications. So this is how I came about, right? So quick rundown on Amplify. It has 20 billion in assets under management as of January 2026. So it's huge. This is a huge fund, so I have no worries. Right, the YieldSmart is known for Divo, QDivo, right? This is just I highlighted because I do own this one, and a TLTP launch, right? So this is some of their what they're known for the YieldSmart strategy, and their philosophy is systematic income balance with capital appreciation, which is why I love Amplified, right? So Niels doesn't really do this, and nor a little bit of Goldman, but Amplify is always going to try to give you growth first and income second, of course, depending on what you choose, what ETF, right? So their reputation, they are not rookies. They've created the income ETF space for advisors. So I want to say they are serious product expansion. It's not just straight PR, not just marketing. They know what they're doing. All right, so let's do a quick institutional deep dive on the hidden fee drag, okay? Talk about the good, talk about the bad. We got to talk about everything else, and I'm going to give it to you. I think, of course, they haven't put it out yet. They haven't released it. The final expense ratio to be determined, but I'm going to model a conservative 0.65, right? So LQDM's real hurdle is at the end 12.65%, and HYGM real hurdle, the expense would be about 10.65, just adding the 0.65 here, right? So LQDM does need to generate about 7.74% in alpha from options just to break even on the promise. Okay, something you guys do have to think about is this, right? So that's the hidden cost here. Generating nearly 8% alpha from stable bonds is hard because bonds don't move much, bonds don't do much. All right, the fee drag does make the 12% target a high bar. Right, and I just say 0.65% because I'm just basing it off of what they typically have their expense ratio around. All right, duration versus credit, right? So this part here, you have to pick your poison here. LQDM is the rate play, right? Duration is about 8 years. What does it mean? It is highly sensitive to Fed policy, right? So if rates drop 1%, the bond price jumps around 8%, right? So if rates rise, it tanks. It's a bet on interest rates versus HYGM. This is the credit play. The duration here is about 2.78 years. What does it mean? It mostly ignores the Fed. Mostly, of course, the Fed does have a lot of play, right? It only cares if the economy crashes and companies go bankrupt, right? It's a bet on the soft landing part, the recession, right? The choice, these are not correlated, right? LQDM loves falling rates, but caps them, while I think HYGM loves a strong economy, right? Choose based on your macro view. Can you own both? Of course. Of course, it's not correlated. In a way, you can own both. You can play both sides, right? So if you're going to pick one, I want to say this is where each one kind of leans towards. All right, let's look at the volatility game, right? This is short volatility, right? So these funds live and die by the move index, right? The bond volatility, right? So looking at this, like low volatility, coverage ratio, 90 to 100%. The outcome, fund becomes static. This is where you have max gap risk. Whereas it's high volatility, right? Coverage ratio is 30 to 40%. Premiums are rich, right? Higher payout, but your fund captures the upside. So these funds are safer in a chaotic market because they require less overriding, right? You actually want some chaos. If the market is too quiet, well, the fund has to sell your entire upside to pay that 12%. So you gotta understand where you guys want to be playing this. Of course, playing both and building around it is another choice. That's why you gotta hedge against the ETFs. All right, let's do a stress test. Of course, this is my scenario. This is my nightmare scenario, my guess. Okay, so take it with a grain of salt. The question I ask myself is, what if the Fed cut rates by 1% instantly, right? The bond rally. So plain, the underlying LQW ETF returns about 8% capital gain, while Amplify LQDM return is about maybe 1.5%, right? This is capped, right? The opportunity cost lost here is 6.5%, right? This is the underperformance. This is my nightmare, right? So if you own this, you have to watch your bond portfolio staying flat while the rest of the market rallies 8%, right? This is the cost of that 12% yield. Okay, my final verdict, right? This is my strategy. If I were to like them and own them, if I were to have a fixed income portion, I'm going to say LQDM is the yield extractor, right? Use it for sideways markets in a 3.5 to 4% rate, but do not use it if you think rates are crashing to 2%. Right? HYGM is the enhancer. I want to say this one is a more compelling alternative to junk bonds. Right? It does boost income to 10% while keeping some growth alive. The summary for these two is HYGM is structurally more robust in a bull market or soft landing, while LQDM acts as a volatility dampener, but does carry huge opportunity costs if rates do fall. And this current administration, they want rates to fall. So know your end game, right? You income investors have to weigh the attractive double-digit yields targets against the risk of NAV erosion and growth potential, right? I want to say these are going to end up, if I were to buy them, these are satellite generators, not core bond replacement. Have them to just kind of diversify a little bit. You don't have to worry about too much. If they're going up and down, just use them to build that income to collect. That's what I would have them for. All right, that's the video. Hope you guys enjoyed it. Hope it was informative. Let me know if you are a Amplify fanboy like I am, and let me know if you're a fixed income pretty much investor here. You like that fixed income portion, right? So you play that fixed income, because I know some of you guys do have I know some of you guys buy bonds, so this is just a cover call overlay on top of it. So let me know what you think of this, of the release. Give me, and if you're new, you found my YouTube channel, give me subscribe, like, and comment below. What do you think? Is this 12% worth the capped upside? Thanks for watching. Catch you guys on the next. Stay tuned.